The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.
Hey everyone, welcome back to another episode of In the Market Trenches. I'm Eric. This is Gary. If it's your first time visiting us, thanks for tuning in. Remember, you can find us anywhere podcasts are available. You can check us out at inthemarkettrenches.podbean.com. You can check us out at SNN.network. You can check us out at the SNN YouTube channel. That's youtube.com/SNNwire. Gary, good to see you.
Hi, everybody.
We're super excited for our guest today. Really happy everyone can join us. For those of you who don't know him, we have Tobias Carlisle joining us to share some more stories, share some updates on what he has going on right now. Tobias, thanks for joining us.
Hey, thanks for inviting me. Thanks for having me, Eric and Gary.
It's our pleasure. You've got quite a background. I think I first came across you through I think you had a blog. Was it Greenback?
Yeah, that's right.
And then I read one of your books, Acquirers Multiple, and now you have a whole series of stuff just based on that. So maybe give us just a little bit about your background before we dive in.
So I was a lawyer in Australia, working in corporate advisory. I started April 2000, and I was expecting to do VC and like .coms were huge when I was just finishing school, and that was kind of what I was going to the school to do. Going to the firm, what I thought I was going to the firm to do. Like literally, I think it was either the day that I arrived or very soon thereafter the collapse started. And it quickly became like there was no VC being raised, there was no VC being invested, and it turned into an M&A private equity type market, which I found sort of much more interesting than the VC startup stuff, because it just seemed a little bit more rigorous. It seemed like there was more meat on it. And through that kind of wreckage, this new breed of investor that, they were basically the corporate raiders from the 80s came back. They weren't called activists when they first came back. They were just kind of like old guys who were back trying to get control of these things. And I'd like read Buffett's letters, and I'd read security analysis, like, page through it, not really kind of absorbing any of it, but like railroad bonds, excellent. I'll commit that part to memory, thinking that I'll never use that again. And then, read Intelligent Investing, all that sort of stuff. And I was looking at them trying to buy this stuff, and I just couldn't, I was like, Buffett, wonderful companies at fair prices. That's what everybody wants. And they were buying these companies that were losing heaps of money. Mm-hmm. And I just couldn't figure out why you'd go through this amount of effort and expense to get control of one of these things, just completely ignoring the fact that what these companies had done is raised tens of millions of dollars. And then because they were burning so much cash, and that made them toxic to most investors, they had traded way down below their cash value. And these guys were just trying to get control of the cash, knowing that they could get on the board, shut down the terrible business, and then they'd have a pool of cash there to go and either liquidate, take the cash out, or then you've got a vehicle that's got tradable shares and cash that you can then go and some of these guys would just do the daisy chain of these things. So they'd use that as the vehicle to acquire the next thing or back in some kind of business. I just found that kind of like a fascinating approach. And I thought that's one way that I could use my legal training and my legal experience to get into it.
It's amazing how these guys think in terms of like, I've met a lot of these types of folks over the years, and they think about it in terms of like captive pools of money that they control. And it's right. It's fascinating that that's the mindset.
Well, you've got two types of currency. You've got the stock that you can use, and often these things, like, they just slightly rebrand it. So where it had been like some .com doing something silly, they just turn it into like a vulture fund and start telling everybody that it's now a vulture to go and soak up these other things. And all of a sudden, they kind of trade up to a little premium to the cash because there's somebody who's not going to go and burn all the cash. Right. So all of a sudden, you can use the stock to acquire these other things, and shareholders in these little busted .coms, they're looking for a way to get out, looking for a way to crystallize a tax loss, looking for someone who's not going to just burn cash. And so for a very short period of time, they just went around and soaked up a few of these things. And I thought, if that ever if that opportunity ever presents itself again, I'll try and take advantage of that. So I got transferred to the States. I went to San Francisco. I just had this little concentration in tech M&A. So I started working in San Fran. There was not much going on. Like the biggest thing that had happened was Google went public via this reverse Dutch auction, which was weirded everybody out there because they were like, why would you get the pop? And then it didn't, I think it came on at like $80 a share, something like that. And it kind of left a bad taste in everybody's mouths. And the only VC that was happening in San Fran at the time, or the only kind of startups, were things that were using Google products to try and get acquired by Google because they wanted to, like a $1 million acquisition because the guy wanted to go and work at Google. Right. And they'd create like literally a mission burrito locator using Google Maps, which was brand new at the time. And so I was like, well, there's nothing happening here. And I had this company that I'd listed in Australia, and they said, we need a general counsel. We're doing lots of acquisitions and buying up all of these busted assets. And we need someone who's got that kind of experience. Do you want to come back and do that? So I did that. I went back, took my girlfriend at the time, who was from Los Angeles. We ended up getting married. I worked in that firm for a while. That got bought. That was one of the best performing IPOs to acquisition. It was like a 600% return over a few years. And then I just had a little bit of money, and I thought I want to learn activist investing. So I found a guy who was like, I always call him a reluctant activist. His theme was undervalued assets with a catalyst. And so what he'd do is he'd find these things that were just way too cheap, like not necessarily cash flowing, complicated corporate structures with the kind of stuff he liked. So in Australia, that's quite popular, or it was for a time. So, Macquarie Bank got quite famous doing these. They'd list these securities where they were called stapled securities. So there'd be some asset like a port or a rail yard or something that flowed money, and they'd put that into a trust structure so it'd flow through without paying tax at the corporate level. And then they'd staple the manager, a holding in the manager. So you'd get a share in the manager as well, stapled to the flow through it. So you're sort of getting a little bit of both sides. And that's, in a bull market, people don't care about how complicated the structure is. And then all of these, Macquarie did it quite well. Then all of these imitators came along who didn't do it as well as Macquarie did it, even though Macquarie ran into trouble too. But in 2007, 8, 9, that stuff just became completely toxic. Yeah. And so we would go through and find these things and work out how we could unpick them and get to the bottom of there was often a good asset in there. It was just buried under debt and a weird corporate structure. So we just work out how to unpick it, reveal that underlying asset. I had a lot of fun doing it, and I thought this is ultimately what I want to do. So that fund was wound up because it got too concentrated into one of the big positions, even though, we were buying it like 11 cents. But one of the big positions was we were buying it at half cash at 11 cents, at 22 cents a share in cash, ended up trading down to 5, and it was just totally illiquid. So the fund got wound up. I started my own little partnership, basically hunting for nets and special situations and stuff that just completely off the run, too small for any hedge funds. And that's what I was doing in Australia. Ultimately wanted to get married. My wife, when you have kids, you want to be close to the grandparents. So we're from Los Angeles. She's from Los Angeles, moved back to LA, and that's how I came to be in LA.
Interesting. So transition to sort of where you are now. I think you wrote The Acquirer's Multiple. Was it 4 or 5 years? I don't remember the exact date, but it feels like it was 4 or 5 years ago.
So when I got to the States, like I had this, the initial structure that I had was this Aussie unit trust, which is the way that, that's probably a sensible way of investing in Australia. Got to the States and I was trying to raise money into that structure, and that was just a total non-starter for the obvious reasons. So I transitioned to a limited partnership, not fully understanding, I think, how a limited partnership should be used. Mm-hmm. And so I raised money, when you're unknown completely with no network, as I was, to raise money, it's always going to be high net worth individuals. And I was using that little blog, Greenback, as sort of the way that I would get in front of people. And that was very tough too. And so I realized after a while I needed a different strategy. And I had through Greenback, I'd met Wes Gray, who was a PhD at Booth at the time. And I had this sort of interest in quantitative approaches to value investing. So we dug up every bit of industry and academic research we could find on value investing, going back to like the stuff that had been around since the 1920s, like the weird old, the stuff that you use to determine if something is creditworthy.
Right.
Like, and they're all based on like manufacturing companies, and they had these weird coefficients in them. Like, does that stuff still work? Does it make any kind of logical sense to have weird coefficients weighting one thing over another?
Yeah.
And then we tested all that stuff, found the stuff that did work, found the stuff that had probably never worked, and it was just like a fluke of the data that they'd found something that no longer applied. And that book was Quantitative Value, and it came out in 2012. And as we were doing that research, I've got this deep value bent. I like the really weird off the run. And I just noticed that all of these, when things get very, very cheap, they do exhibit these weird behaviors because the management doesn't like the company being that cheap. All of a sudden it attracts activists, it attracts private equity firms. People want to bid for these things, they want to sell assets. So second book called Deep Value that came out in 2014. And I started getting a little following as a result of that on Twitter and in other places.
Right.
And I could see that the way to use a smaller following like that is through a more public vehicle like an ETF. So I spent basically from about 2015 to 2019 trying to work out, because they have been very, very expensive funds to get going. They've become much cheaper over the years, but initially they were like $1 million to get going. I didn't have $1 million to stick into it. And then, so basically it got to the point a few years ago where the cost had come down enough and my assets had sort of got to the point where I could do it myself, which is what I wanted to do. So I launched the Acquirers Fund, which is a long, short, deep value US focused fund. It's at its maximum exposure, it's 130-30, but I can move that around a little bit depending on what the opportunity set looks like. So it's long, really deeply undervalued cash flowing assets where management typically is doing the right thing and buying back stock. Short stuff on the other side, that's statistical fraud, statistical earnings manipulation, heavily levered negative cash flow. It's since it launched, the market has been still pretty hostile to that style, but I think that's a short-term phenomenon. It's one of those things that the market does go through these periods of sort of whether these little boomlets and fundamental investing doesn't work, and then it all comes back into vogue very violently, and that deep value style does tend to do quite well over periods of time. And so more recently, because that long short fund is only focused on the top 25% of listed companies, just because to short, you don't want to be shorting in stuff that's too small. You're very subject to the illiquidity and what other people are doing in it. So I've recently partnered with the Roundhill guys to launch, a competitor of mine in Zig got into trouble or decided they didn't want to run the ETF anymore. So they tried to abandon the ETF, and Roundhill kind of got control, and we have basically managed it together. So I provide the portfolio for it, and it's focused on the smallest 75% of companies, which is smallest 75 by market cap. It's roughly sort of Russell 2000 and below. It's like a minimum market capitalization of about $75 million, which is an NYSE listing rule. And then the maximum market capitalization is sort of $2 billion-ish. So it's small and micro.
Right.
And it's a little bit more diversified, but I think it's kind of like it's a super interesting part of the market to be in, because the companies just get so wildly out of where they should be, because there's a lot of, there's weird stuff that goes on there. We can talk about that in a little bit.
Yeah, so full disclosure, we're not investors in the funds, and nothing that we talk about related to the funds is an offer or solicitation to buy the funds.
Yep.
But it's an interesting strategy because, like, part of what Eric and I do in some of our kind of more special situation type stuff is, we try to go where we think there's high likelihoods of being mispricings, for better or worse. And so what you're saying, being in the top, was it 25%, the bottom 25% of the market cap?
So it's bottom 75, but that's that.
Okay, so you're avoiding the top 25% of the market cap, but I mean, there's more. If you're doing that, I would assume that there's more likely to be mispricing either one way or the other, wildly overpriced or wildly underpriced. Is that sort of?
I mean, it's the mispricings. The mispricings, like I don't think that it's very rare to find mispricings that are that there's no reason for the mispricing. Like every time I find a mispricing, it's because management. There's a lot more risk in small and micro companies. For one thing, they don't have the resources that mid cap to large cap do have, and there just aren't as many activists and private equity firms kind of roaming around keeping these things in line. Often they're controlled by founders who are idiosyncratic, kind of unusual people, and you kind of have to be a little bit that way to get these things to that point. But then a guy who's got something going and is worth a lot of money and is in control, you're subject to what he wants to do running that company. And sometimes they're not necessarily running it for the other shareholders, they're running it for themselves. So there's a lot of hair in small and micro, and you're doing a lot of handicapping. Is this thing unfairly undervalued despite the fact that there is this obvious issue with this thing? Or is this thing, fairly undervalued because this is a real issue? And so that's a lot of small and micro. You guys would know from there's more special situation stuff, like things are undervalued because they're illiquid, or people who hold them don't want to be in them for a variety of reasons, because that they've already got a massive loss in it. They want to crystallize the tax loss for the end of the year, or whatever the thing might be. And so that a lot of the small and micro work is just that, like literally handicapping these things. Are we getting a good return for the risk we're taking here?
Yeah. So can you just, like, at a high level, sort of just walk us through the investment process? How does it start? And then, you're quantitative in nature. Is it all quantitative? Are you doing fundamental work? Are you looking at the accounting and the cash flows and the balance sheet? And I'm sure you're screening for those things, obviously, but how do you date? Just kind of take us through it just a little bit.
So the process is we're using the acquirer's multiple as the first cut. So from the book, that's just the way, a very simple metric that private equity firms and activist firms use to identify things that are undervalued. And so you're looking at enterprise value relative to what this thing's earning on an operating earnings basis. That's sort of the first place. We're looking for things that are cheap on that basis, but that's not the valuation. That's sort of the pricing of those things. And I think it's true that if you buy enough of these things cheaply enough, you will get good performance. But I don't think you can't stop at that point in a fund. I think you need to sort of go beyond that to see if these things are worth earning. Because as I was saying before, there are a lot of issues with them. So we're trying to make sure that the cash flows match the operating income, that there are no huge liabilities. This is not uncommon. Huge liabilities that are in the notes that should be carried on the balance sheet. Everybody would agree that that's a liability, that's a risk. Convertible notes that convert at some very sweet price. So the screens can't pick a lot of that stuff up. And the idiosyncratic accounting from one thing to another thing makes them difficult to compare on an apples to apples basis. So there is this forensic accounting stage that we go through to make sure the economic reality of the company matches what the screen says that it is. And that was something that I used to do by hand. That was like a decade of being an M&A attorney. Sort of teaches that. That was a lot of what we were doing, producing the filings and the documents, the prospectuses, making sure that they reflected what was actually happening in the company. Now I use a service that sort of does it, and we cross-check what they do as well. But basically, that's the idea. We're trying to find super cash-rich balance sheets, buying back stock, which I think is a pretty good signal that there are multiple things in a buyback. If something is undervalued, and we already think they're undervalued, but a buyback tells you that management's also aware that the thing's undervalued. And that sounds funny to say that, but there's a lot of managements who just don't ever think about the valuation of their stock relative to where the company's trading.
Yeah.
We know a few of those where we had to explain the difference between, buying in your stock today at a low price versus future earnings. And like, if you think your earnings are going to be 3 or 4x a couple of years out, you're buying it today at a quarter of X. It's like, that's probably the best deal that you can get as long as you don't need to reinvest the money in the business. It's like some of these guys, it's like they're not
they just don't think about their business that way.
Yeah,
that's it. It's because we're finance guys and we approach it as a finance question first, whereas a lot of these guys are product guys or engineering guys, startup guys, and they approach it as a product or engineering problem first. And they've got, it's a huge, often for these guys who've listed these things, it's a huge achievement to have got it to that point, to have got it listed. And they're focused on growing the business without ever thinking about the stock price relative to the business. And I've done this when I was an activist. We used to go in and say, have you thought about buying back stock? And they're like, why would we do that? So and we just explain that very simple thing. That nobody had ever said it to them. It wasn't that they weren't resistant to it. They just never thought about it. And so we'd say that, and often that was enough just to begin a little buyback in these stocks. So that makes a huge amount of sense. No one's ever kind of explained it to us in those terms. Like, they're small businesses. The guys sitting on the board aren't investment bankers from top flight funds or guys who think in terms of investment. So I found that to be, that's very effective. So when I find someone who's actually doing it, that's a very strong signal in a small cap, micro cap world. And it also says they've either got the cash on the balance sheet or they've got the free cash flows to support that kind of buyback, which is another very powerful signal. Mm-hmm. And then, so just undervaluation, healthy balance sheet, healthy cash flows, buying back stock, pretty strong signals. And across a broad enough portfolio, I'm reasonably confident that over a period of time that should win out.
Approximately how many different names do you feel like you need? Because I feel like if you're looking for statistically cheap things, I think on average they'll think they tend to work, but you can have a really wide variation around that average. So how many is enough for you? And how do you think about that?
It varies depending on the market cap. So in the larger cap stocks, I think you need fewer. You can be reasonably confident that they just don't get that undervalued. When I say not that undervalued, stocks clearly move around like 30% on average from peak to trough, even in a large cap universe. In a small cap universe, any given day, the whole portfolio moves around 3%. So it doesn't, the whole portfolio can move around that much. Right. So you need much, much broader exposure. So I don't think you can get much more concentrated than about 100 positions. I mean, you can, but then you become very, very volatile at that. Mm-hmm. Like 100 positions in the fund, the last few weeks, like every single day has been like a 3% day up or down. They're gigantic moves in the sort of small and micro cap stuff. You've also got the problem that, you're limited by your smallest position. So if there's a $75 million position in there and you're trying to put a material portion of a fund into it, there's a natural limit on how big that fund can be. Even at 100 positions, it's never going to be a very big fund. It's always going to be quite a small fund. But I think that's okay because it's a performance fund. Like, it should demonstrate pretty solid outperformance. And that's kind of what I'm chasing at this point in my career. I want to show that these things generate good returns.
How do you manage that in the context of an ETF? Let's say, so with ETFs, you don't necessarily know who's going to be come into play in your sandbox that day. Money comes in, goes out, whatever. It's not an LP structure has the advantages of being gated. You can have lockups and that type of thing. So for I get the diversification is helpful in mitigating some of those issues. But you get a big cash flow that comes in or a big cash flow goes out. Like, how do you sort of deal with that as the manager of one of these things?
One of the nice things about ETFs, which makes it different to managed accounts and limited partnerships and other things like that, is that I don't necessarily have to deal with those things because there's a market maker, lead market maker who's responsible for that. So the lead market maker is dealing with the flows, and the way that the ETF works, they've got this custom create redeem function, or create redeem just doesn't have to be custom, just create redeem function, where they're creating the portfolio as a basket and then exchanging that for units in the fund or reversing that process. So I don't have to think about flows as much as a mutual fund does, for example. I think about the portfolio. Big movements like that are either way, make it more difficult for the market maker. And there's also some rules around what we can include in terms of liquidity and sizing. Right. But, if you're used to dealing with small and micro cap stuff, the $75 million cutoff for a minimum seems quite high. There's lots of companies that you can buy for less than that.
Do you have any liquidity requirements in terms of how you manage this? Because I can tell you that I think we're involved in a couple of companies that are 100 million, or more, and there's just days where they don't there's days I've experienced days with certain companies where they've reported earnings and the stock's not traded. So like it's like if the company reports earnings and stock doesn't trade, did the earnings really happen? Who knows, right?
Yeah, so there are minimum liquidity requirements, and it's just like over the last 100 days how much has traded on average, and we can't buy them below a certain liquidity requirement. So those constraints, they take away some of the performance of what potentially you could achieve in a limited partnership where you could get concentrated into these things and not care. But then limited partnerships also have to deal with liquidity issues, even gates and lockups and those sort of things aside. Yeah. I just find it. I think it's entirely appropriate given certain strategies to have those sort of things. But for an ETF, and many of these things are pretty liquid, it just seems to me that it doesn't really make that much difference if you're selling some of these positions out to accommodate a liquidation or an investment. If the good things happen, to buy those things. So I think that it's worth it to provide the kind of behaviors that ETFs do.
That makes sense.
So Tobias, I think producer Bobby has shared with you a little bit about the background of the show, how we came to be, what we want to do. We want to talk about a story from in the market trenches. We really put our ego to the side when we talk about some of these stories, and we just share some of the war stories that as investors we all have inevitably faced. So is there any one particular story that kind of shares out that you might be willing to share with us?
I'll have to think about it a little bit as I'm going through, but I can talk a little bit about one of the holdings that I have in a fund, and you guys probably know this. Everybody, I think he's pretty well known, but Big Larry Holdings. Do you know Big Larry?
No. Big Larry, no.
I'm sorry. We do Big Larry. Sardar.
Sure.
Yeah,
that's it.
We know that one. That's the guy who bought. Was he only? Did he spend a ton of money on some Wu-Tang album or something, and he's the only one that has it? That's the guy, right?
Isn't that? I think that's no. That's not Big Larry. He hasn't done that. Big Larry's. That's you're thinking of Shkreli.
Right.
That's right.
Yeah. Big Larry is the guy that bought Maxim, right?
That's it. So Big Larry, I think he's such a good example of what you find in the small and microcap world, because he is a very talented investor over a long period of time, 20 years, and he's still a young guy. He's only mid-40s or something like that, I think, which is relatively young for someone who's got 20 years of experience managing funds. Like he's got this 20-year track record, which has outperformed the S&P 500, despite the fact that it's been very rough for his style of investment over the last sort of decade. He ran the Lion funds. He used them to get control of Steak and Shake, Western Sizzlin, these kind of businesses, and he's rolled them into what has now been turned into Big Larry Holdings. And it's Big Larry Holdings because it's BH, because he's a fan of Berkshire Hathaway. Right. But the really funny wrinkle is that he made the public company buy his fund, and then the fund has invested in the public company in this sort of roundabout, weirdly cross-holding kind of way, with the effect that he's basically entrenched because there's A and B shares. He basically controls both. Plus, he's got this incentive structure built into it now that's like the Buffett partnership. He's got a 0.625 incentive structure in this thing, and so he's very shareholder unfriendly. He's very dismissive at the meetings. So people go along and ask him questions. He just sort of says, it's my way or the highway. I'm in control, and you're here for the ride or not, and it makes no difference to me whatsoever, which makes people understandably pretty upset. So that's why the stock trades at a huge discount, and it's because it's this weird structure, and they're running the investment losses through the income statement, which you have to do now. It looks disastrous if something happens to the investments, which has happened now.
So based on your background and what you sort of described with untangling sort of weird structures, it sounds like you're sort of uniquely suited to sort of examine this and understand it.
This is a good example of what we do. So putting all of that aside, so that's the reason why it's trading where it is. Mm-hmm. Another way of looking at it is this guy is basically, or it's all of the very vast majority of his wealth is in this thing. Plus, he's got this incentive structure that's 0.625, and there are lots of hedge fund managers out there who've got followed that Buffett model, who've got that 0.625. I think that's in a world of the 10 years, like 80 bips, I think that the 0.625 structure is possibly even unfair to the manager. I mean, it's a pretty good structure. I wouldn't mind having it, but it's probably, the 6 is high, given that when Buffett put it on the 10 year, it was probably at 6. So it's sort of, it's not a bad incentive structure. And from what I've seen, like his investments, I don't think he's really put a foot wrong. He's buying traditional deep value stuff, and I think that he's buying it pretty well. And so I think if you can unpack the accounting and get comfortable with him being in control and sort of being dismissive of shareholders, but being a very talented investor who's heavily incentivized for this thing to work, and you view it as sort of investing in his hedge fund, but at a massive discount to cash, then all of a sudden it begins to look like if value turns around, and I'm a believer in value turning around, I've got these sort of positions in my fund. If value turns around, all of a sudden this thing is going to be a completely different kind of entity. And it's not hard to see how, given 3 or 5 years, he could, there's a return of the startup Big Larry. He's back. He's doing really well again, and the stock trades potentially at a premium to the cash that's in it, which is it's trading at a big discount at the moment. So that's kind of that's a good example. It's a good example of what I look for, something that's like complicated, kind of a little bit of an ick factor to it, but is ultimately still probably a pretty good investment.
Right. So with that particular one, you've got somebody who's entrenched, who's in control. There's been some, I'm going to say, related party dealings. I think it's fair to say.
It is, but it's all disclosed, and nothing's happened unlawfully.
Right.
Sure.
How do you get comfortable that like you're allowed to be along for the ride and that you're going to be treated well alongside of him in a situation like that?
Well, at the moment, it's trading at a big discount to cash, or cash and marketable securities. So there's that. You have that as part of it, but also like he doesn't get paid unless this thing really starts working. And
Right.
when I look at what he's paid to do, which is essentially he's there to make investments. He does some operations of these the restaurants that they've bought, and he thinks like a capital allocator. He's trying to turn them from being company owned into being franchised to free up that capital.
Right.
Like the things that he's doing are sensible, are good ideas. They're sensible things to do, and his incentive structure is such that if they work, that's the only way that he gets paid.
Right.
And he's also wholly his huge amount of his wealth is in this thing. So for a variety of reasons, it has to work for him.
Right.
So I don't know what his wealth is. Is it such a large number that it doesn't really matter whether or not it works out for him? And for some of these guys, they're just worth so much money that these things become pet projects for him. And so whether it's wildly successful or not, it doesn't make a difference to them personally.
I think that most of his wealth is in this thing, but I think that more than his wealth, it's sort of, it's like it's ego that really needs to make this thing work. And I don't know which is a more powerful driver, but they're both very powerful drivers. I mean, he's called it Big Larry Holdings because he likes the BH, because he's got that ticker. He wants to be compared to Berkshire.
What do you think he needs to do to close the discount? And do you think it's within his power to, at any point, could he decide, I'm ready to close this discount, I just have to do steps 1, 2, 3, and I think I'll get an immediate re-rating?
No, well, I think that he's doing the things that you would need to do to get that re-rating. What needs to happen for him is that, value needs to kind of turn around a little bit. Deep value needs to turn around a little bit. We can talk, we can talk for a long time about what's happened to deep value over the last sort of decade or so.
Right.
The people who have survived in this business are the deep value guys. There's this litany of deep value shops that have closed up or become family offices or just not been able to survive. And there are guys like David Einhorn. So I distinctly remember when David Einhorn was regarded as a genius. And I've seen Einhorn pitch at value investing congresses and things like that. Nobody does more research than David Einhorn. Mm-hmm. He hasn't gone from being the GOAT to being a GOAT over 2 different decades. Something has happened over those 2 decades where once his strategy was probably, overly favored, there was probably a golden era of value coming out of the .com crash. So probably he was never as smart as he looked to be, But now it's gone the other way where it's been unfairly punished. And now I don't think he's as dumb as he looks to be. And I think that often that's sort of what we're trying to do in this business. You look at the trajectory in this business. Is this because management has just completely lost their mind for a period of time, or there's sort of exogenous factors? Are there things going on that just make them look dumb, but they're doing what you would want them to do? They are going to survive. While they survive, they are taking advantage of the undervaluation, and they're putting themselves in a position where at some stage this industry turns around. When the industry turns around, they're going to make a lot of money for a long period of time, because it's just you can't go back into that industry immediately. You have to reinvest in that industry. So that's sort of that's the way that I think about it. Is I'm looking for something that the business is beaten up, but we're trading at a big discount to a trough valuation. And so if we get that if we get some mean reversion in the business and we get the discount to the value closing, like there's potentially very good performance in here. That's how I think about investing in cyclicals. And I'm prepared to invest in cyclicals, knowing that it's very, very difficult to get the bottom. No one's ever going to get the bottom. And, oil and gas has been kind of mind blowing how far down the bottom really is. In that I've been in the markets for about 20 years. I've seen $100 oil twice, with this idea that it was going to peak. Each time it was peak oil, and I never thought that I'd see it. But that we've seen negative oil
that's pretty
price.
amazing, right? 2020 is a year where I thought we'd seen everything, and like by April, and by the end of April, I think we were staring at like negative $30 oil, and I was like, well, this is everything.
We're pretty creative guys, and I don't think we had that one.
That wasn't on the board.
I didn't think it would eventually go negative, but I wasn't smart enough to see that.
I think the craziest thing this year is that the New York Times carried this article basically saying we've found off-world vehicles, or we've got a strategy for dealing with off-world vehicles. And like nobody's even read the article. They're like, I was just too busy that day. There was too much stuff going on. Like UFOs is like number 6 on the list of things that happened this year,
Yeah, I mean, it's a list of oddities. I mean, and then the election on top of it, and we still don't know how that's going to shake out. And it's just like, I just want 2020 to be over.
Well, I hope that 2020 is over when 2020 is over, but 2020 is one of those years that, you might still be dealing with 2020 by June 2021. I always think, like, every time that there's been a world war, the story that they always say is the boys will be home by Christmas. And like 5 years later, they're still fighting over in Europe somewhere.
Christmas is what year?
Yeah, that's it. It's a truism. It's going to be Christmas. Just, we're not going to tell you which year.
It's funny. So the Buglari thing, just to close the loop on that, I think I've seen him file a bunch of Form 4s, so I know he's buying stock. Or at least I haven't seen it recently. To be fair, I haven't looked recently, but I remember over the last couple of months, I think I've seen that. So he's buying. I think I've seen him buy stock. The company is also buying stock.
Yeah, there's buybacks at every level. There's he's got sharp elbows, Sada. He's probably buying more for himself than the company's buying for itself, but. That's why it trades where it does. Like it's in this market, it's hard to find things trading at a big discount to what is essentially cash. They're cash and marketable securities. It's like a third of cash and marketable securities. You don't get the discount like that without significant hair. But I think that some of the hair is, I can look through it and see that it could easily turn around, and the things that they're pointing at now as being negatives could be positives. It's the incentive structure that made him start performing the way that he did, or it was the fact that his name is on the door and it's performed so badly and he needed to turn it around.
So with that one, if the strategy turns around, they're going to start booking profits on the strategy through the P&L of.
I think that's what happens. Yeah.
Okay. Interesting. So, oftentimes for us, when we look at these things, like, the first thing I ask myself or ask Eric is like, what's going to make it go up? And so oftentimes for us, it's like, is this thing getting better? Is it getting worse? Or is it staying the same? And can we tell? And so it sounds like, there's a very strong emphasis on the can we tell part of the equation. So that it's, a more favorable environment. I mean, that in itself sounds like it could be its own catalyst.
And the other thing that, like, I've got a point of the fund in this thing. So it's just the nature of the small and micro. We're never going to be hugely exposed. I think that for risk reward of something like that, a point maybe that's a little bit too little, but a point is about appropriate. I could be, that's sort of an option size position. That's the nature of a fund like this, that it's filled up with about 100 little call options on binary situations where the outcome could be, asymmetric binary situations where the outcome could be quite big. Like, it could be as simple as they just start doing a little bit better, and then that comes through the income statement, and all of a sudden it shows up on some other screens.
Yeah. So full disclosure on the Bulgari, then you own it in the fund. Do you own it personally, or
no? It's through the fund. I only hold the funds.
Okay, and we don't own it. We've only casually sort of followed the story from afar. That's interesting. So maybe what we can do is talk a little bit about sort of the deep value and deep value, and the woes of value and deep value, and what is value and what does that mean, and maybe we can get all existential.
Well, let's talk about, I've got some older activists. This is nothing in the fund. This is nothing that I've done in the States, but the activism is kind of a funny world where you're always running into colorful characters, because it's the idiosyncratic characters that kind of get these things going in the first place. You've got to be a little bit weird to kind of get it to this point. But I've had lots of fights with, so there was this company in Australia that made steel accessories for cars, basically bumpers and like the things that you attach the lights on the front of the car, all that sort of stuff. And they had these two securities. They had the common, or the ordinaries as they're called in Australia, and they had these preference shares. Mm-hmm. So the prefs had been cumulative, and then they did this funky conversion where they turned them into non-cumulative, and then they took away some of the rights. And so we got control of a big chunk of it. Initially, went to the shareholder meeting. So this is a great trick. If you get control of the chair from a shareholder meeting, it gives you a lot of power to do a lot of things. You can call on votes on the floor. So that was our strategy, to go and get control of the chair. We put some people in the audience who had some proxies of ours, and so we could vote it in on hands. They knew it was coming, didn't get it through, but we had to stand up and kind of make these pitches. And then you have these small shareholders who are, don't really know what's going on. They just know that the manager is their guy, and these other assholes over here are kind of trying to fight with their guy. And so they start standing up and giving these, like testimonials about what a quality human being they are. And I'm like, they've literally just robbed you blind. Like, they've put their hand into your pocket, and you don't understand what's happened to you. When, I'm not trying to debate it with them on the floor, just sort of pointing out that was my thought process at the time. Right. So it was a very hostile room. Ultimately, we didn't succeed there. So we took them to court. And then at court, it became this legal argument about, this is what had happened. They declared the dividend. Sorry. The dividend was payable. They hadn't declared it on the prefs, as a quarterly dividend. It hadn't been declared, but it was payable. So we took them to court to try and get them to pay the dividend. There's hundreds of years of case law that say that there's no dividend payable until they declare it. That's just an established rule of law. But we had, fired up the barrister in Australia to, you're going to make some law here. You're going to overturn like 130 years of pretty established case law. From
essentially the judge in this.
No, the barrister's the advocate. The barrister is the attorney. So in Australia, there's a distinction between solicitors who have very limited rights of appearance at court, and barristers who can appear anywhere. And so the barrister, they follow what's called the cab rank rule. So if you engage the barrister, they have to appear on your behalf. So you hunt around for guys who are commercial, who understand this sort of constitutional corporate interaction, and then you give them these assignments that suck. Like, there's nothing that this guy can do. And I know there's nothing this guy can do, but I just want to kind of get these guys in court and show them that we're serious, and we're prepared we're going to litigate every single part of this kind of story. So we got them in court, made it like what I thought was a pretty compelling argument, fully knowing that it was never going to get up, but make it sound good. And then I saw the judge kind of wavered, but ultimately rendered the right decision, which was the wrong decision for us, but the correct decision at law. And so they won that. And then we just sort of continue this war of attrition with this guy where we'd buy the ordinaries and try and get them tipped out, but they're in control position. So ultimately we prevailed because the guy passed away halfway through the battle.
So isn't that like the story where like the king sentences the guy to death, and he's like, "Well, give me a year to make your horse talk." And when they're leaving, the guy's like, "Oh, you're nuts! You're never gonna be able to make that horse talk." He's like, "Well, all kinds of things could happen in a year. He could change his mind. He could die. He could, Right. That's like, it sort of reminds me of that story a little bit. Believe it or not, you're the second person on this podcast to talk about an Aussie press story and a barrister. And I did not get the definition of the barrister.
What was the other story?
It was a guy, Chris Summers. He actually used to work at Greenlight, a fund that you mentioned. And he had his own fund for a little time. And he was talking about a paper company that had a pref. And I forget the name of the company. We didn't say the name of the company because there was litigation. That's thank you for the hand waving.
There's litigation. I guess some of the people involved were pretty high up in Parliament or the judicial system over there.
They're pretty well connected, and they didn't want to be embarrassed. So ultimately, they wound up working out in their favor. But it was the return on brain damage that he described was, it makes you wonder if it was worth it.
But that's the nature of activism, right? There's everybody else is just like, this is too hard, so this is too hard, this is too hard. And finally somebody says, you know what, there's enough return here. And the kind of personalities that are good at this stuff are the, ambulance chasing lawyer who is an activist, the people who just inflict psychic pain on other human beings and don't absorb any of it themselves are very good. But that's ultimately why I'm not an activist, because I absorbed the psychic pain. Like, I hated sitting across from this guy. Right. And he was just like, what are you going to do? And I was like, well, I don't really have many tools, but I'll just keep on going for a while and see what you do. And that was not the way that I was planning on winning, but not that we won. Like that basically the holding got passed down to his daughter, and then and she was sort of like, well, I don't know what I'm doing. So, but I'm still holding on to the shares. So it didn't ever get resolved favorably, but it did trade up a little bit.
Okay. Well, so that's a situation where you got somebody that's entrenched, that's hard to get out and sort of try not to.
You're never going to get them out. You're just basically never going to get them out. The only way, Dan Loeb, I had some comment. It was either Dan Loeb or Bob Chapman, Robert Chapman III. Do you guys remember Chapman from like maybe a decade or so ago? He was an LA-based activist.
I don't know him.
I never ran across him.
He was like a small and micro. He was a small the fund. I think it was called Chapman Capital. ChapCap.
Okay. No, I don't recall that one. But
he was the guy who invented the 13D letter, where he'd write the really nasty letter where he'd like.
Right. I think I might have read about him in Jeff Graham's book. Was it Dear Chairman? Was he
possible? Yeah.
Because there were a whole bunch of really good stories in that book that I liked. And
yeah.
I think my favorite one in that book was Ross Perot, who was a great
that was a
great A badass. Like, when he passed away, he did not get enough credit for getting his own jet and his own former Navy SEALs to get his guys out of Iran. Like, that's just
right
a boss move if I've ever heard one. I digress.
The only point I think he is in that book too, and I think that Jeff did credit him with inventing the 13D, but he basically gave the idea to. He knew Dan Loeb. They knew each other pretty well, and so Dan then sort of perfected the 13D letter. And Dan's view was just that these management teams become so deeply entrenched. There's just no way to get them out by voting. The only way to get them out is to embarrass them out of their position.
Yeah, I think that there's some truth to that. I think I've seen that work over time. I've seen people get tired and sort of go away. But I think it's if you keep
presuppose that the person can be embarrassed, and some people you cannot embarrass them. So it doesn't work for everybody.
The primary nuance that's required there. Do these people have any shame?
That's it.
Where's that on our checklist, Eric? You have it on our checklist somewhere. Do these people have shame? Yes or no?
It's on the checklist now. Yeah.
So we want to talk about value for a little bit and how that's gone and some of what's going on out there. I mean, we've got the cubes ripping today, and so the gap widens.
It's not a good day for. I like every child wins a prize today, but for undervalued small and micro equity. That was the only place that doesn't seem to be going up today, but it did pretty well over the last few days. So who knows? I think you see a lot of volatility. Often that means there's some sort of regime change coming, but who really knows? Value's been beaten up. Nobody knows that better than I do, and everybody knows that pretty well. I think the reasons why, it's to the point that when I look at the portfolio, the dividend yield across the portfolio is higher than the dividend yield Russell 2000, Russell 3000, S&P 500. The growth rates in the portfolio are higher than the S&P 500, Russell 2000, Russell 3000. If I think that that's the way that valuations, if that's what I think that things are worth, you don't need any multiple re-rating for that asset class to outperform these other asset classes. Now, outperformance might not be enough. I think that the markets are very, very expensive. So it's possible that we just do a little bit better on the way down than they do. And that wouldn't be great. But I can see that baked into it now. There are pretty good returns that should be baked into it, ignoring what the multiple does. But I think that if it starts working, then naturally you get multiple re-rating through that. So I think value is so beaten up. And the crazy thing is, I know a lot of these names that are in the portfolio because they were previously in the top 25% of names, and they've fallen into the bottom 75% of names just by virtue of the fact that they're so crushed.
Yeah.
They're things that they're just unfairly valued where they are. And I think that if they were trading at like 30 times earnings, you'd say, well, that's reasonable given the performance. It's just that for whatever reason, the market sometimes just falls out of love with stuff. And it just trades down, and it gives you this opportunity to buy these things where you can see I've got a good yield, I've got reasonably good growth in it, and it should work out whatever the market thinks of it. If the multiple stays the same or even deteriorates a little bit, they still deliver performance over the next few years.
Yeah, I think for us, so we run for clients, we run two individual equity strategies. One is more growth-oriented strategy, and the other one I would describe as more a value-oriented strategy. But we try not to underwrite a lot of multiple expansion into whatever we're doing. We typically try not to underwrite multiple expansion, particularly on the value side of the portfolio, because you can't really count on it. And sort of the underlying philosophy for us is over time, stocks tend to follow earnings and cash flows, and
right.
And that's generally it. Do you think we're familiar with academic research on the value premium? I think somebody won a Nobel Prize for that insight. Do you think that that's actually something that's structurally embedded in markets, or do you think it maybe is more of a cyclical thing that kind of comes and goes and shows up at various times?
Yeah, I honestly don't know. It certainly seems to be. It certainly seems to be cyclical. It's not. It's definitely. I mean, it's the last 10 years show that it's cyclical. It's disappeared over the last 10 years. I think the O'Shaughnessy's have got some research about this where they show that what typically happens for value stocks is that the earnings drift down over the holding period, but the earnings drift down less than the market expects. And so you do get this multiple expansion while you're holding. And that is ultimately how value delivers returns, that it's not so much, they only do better. They do better to the downside perhaps than people expect. And so there's a little bit of multiple expansion. That's how the return happens. So it is a sort of a multiple re-rating story. And growth stocks are the other way around. People just overestimate how much it's going to grow. So even though they do grow more over the course of the holding period, there's some compression in the multiple, and that's why they tend to underperform as a group. That's not been the case for about the last 10 years. For the last 10 years, it's actually been the things that are growing that have had the multiple expansion, and it's the things that are shrinking that have seen multiple contraction. So where 10 years ago, and certainly when I was writing deep value, I probably hadn't quite appreciated that, well, I didn't know this was coming, certainly, and it probably was already going on, and I didn't really realize it at the time. But I would have said that you could almost bank on multiple expansion in a lot of these things. Like it probably is something that you're just going to see it. That's just the nature of it. And I think that what I've learned over the last 5 years or so is that multiple expansion is something that just seems to, you cannot rely on it. It's not going to be there. So you really have to make sure that you're going to get the return somewhere else. And the sources of return are yield, growth, and multiple expansion if you're lucky.
Multiple.
Yeah.
Yeah. Better or worse. Do you think what role do you think just the level of interest rates and the growth outlook generally play into these valuations?
It's such a hard question because what I want to say is that it's not my fault, and interest rates are so squashed and running against me all the time, and it's this duration argument that's pushing up growth. But the real answer is I don't know. I mean, AQR it's such a compelling argument, right? It makes so much, it makes abundant sense to me that growth stocks are more like 30-year treasuries, or make more like the long bond. Duration makes them more sensitive. They're going to go up a lot more. When that reverses, it's going to be a bloodbath at the growth end. It's going to be better at the value end. But then I read the AQR paper, and they say, well, if that's the case, like, let's think about what does it mean for it to be? Are we talking about the shape of the yield curve? Are we talking about absolute movements in interest rates, or how are we defining the interest rate? What are we actually talking about when we say that? So let's just go and test every single iteration of that against performance in equities and see what still stands up on a statistical basis after we do that. And they find that nothing does. That's kind of the shocking thing to me. So it's one of those things that I think it's a really theoretically, it's very, very compelling.
Right.
Empirically, there's no support for it.
Yeah, I think so. I mean, my comment on it is on that aspect of things is like, ours is a profession that is more social science in a lot of respects than hard science, and I've noticed that there's a lot of physics envy amongst the practitioners in this business. So I don't know. I have a hard time digesting the various arguments for that. It's whether it's there or not there or whatever. It's tough to say.
It certainly seems to me that higher interest rates make, there does seem to be some relationship between the value premium and interest rates. If you've got higher interest rates, it does seem to be that there's more value premium there, but it's just not supported in the data. It makes sense to me that if you can, you're looking at it's always a question of alternatives or opportunity cost. So my opportunity cost right now is an 80 bip 10-year with a whole lot of duration risk in it. Who really knows what's going to happen over the holding period of the next 10 years? Like interest rates could be negative. Interest rates could go back to long run returns. The range is something like that, right? So if interest rates go negative, then you probably want to be in the growth stocks. If interest rates go positive or massively positive, does that then start impacting the underlying businesses of the value stocks, which tend to be kind of heavier industries and maybe more levered? And do they get hurt in that? So it's hard to come up with a scenario where value works.
And to what extent do you think maybe it's like a sector phenomenon in disguise? So like you've got a heavy tech and healthcare on the growth side versus heavy financials, and at one point energy, it's a lot smaller. Energy used to be, I think, 15 or 16% of the value, right. And now I think is it 3% of the S&P and 6% of the value benchmark, like something like that, right? Like but it used to be way bigger. And right. I don't know if that's part of the performance issue or not, but
I think that's so. That's almost certainly the case that it has been a big part of the performance issue, because if you look within the sectors or if you look within industries, they still do follow. It is still the undervalued stuff that tends to outperform. It's right. Just that when you're discretionary across every industry, you're just going to be, and you're approaching. It might be there's been a lot of work put into. Are our valuation approaches wrong? Is there some reason why we're applying? You should be thinking about energy the same way you're thinking about tech, because they're different businesses. One's very asset light, one's very asset heavy. One's going to absorb a lot of capital. One doesn't need to absorb capital at all. One probably grows throwing off capital. That aside, if you're just on simple ratios and simple metrics, if you're thinking in that way, you're more heavily exposed to the heavier industries like energy and financials and those things. And it's been a disastrous decade for those things. And it's been a very good decade for tech. It's probably true, but prospectively, I think it was incredibly hard to see that was going to be the case. I think the way that I've sort of started thinking about it, in 2015, a friend of mine, Jake Taylor, wrote an article where he said this is the worst opportunity set for value in 25 years, just in the sense that there was so little dispersion. Everything was very compressed. And Jake at Economic, who's a Twitter handle, he pointed out that he had the Morningstar style box, like large to small, value to blend to growth. And he said every single one of these PEs, these forward PEs, are roughly identical, which is wrong. They shouldn't be all the same. Small shouldn't be the same as big. Mm-hmm. growth shouldn't be the same as value. And that came out, and he posted that in about 2015, something like that. Since then, they've probably gone back to where they should have been. There should have been discounts in some and premiums in others and so on. Mm-hmm. And that ride has been incredibly painful for value. But I think it's probably overshot.
Last 3 years or so has been particularly rough.
Right.
Yeah. It's funny you mentioned Jake. I used to watch his YouTube videos that he would do. Bobby's telling us it's time. Producer Bobby's telling us it's time to land the plane, though. We can have Jake on. I don't know, because I think he runs a fund now as well, right?
Jake's got a he's got a firm that he's got SMAs in the firm. Typically invests IRA assets.
I see. Okay, yeah, maybe we can have him on and talk about something, because I used to enjoy his 5 good questions. But,
very thoughtful guy. Very, very thoughtful guy. Like if I have some sort of question that I want, in a philosophical sense, thought about, I go and talk to him, and he's already thought about it, and he's got the philosophers who've dealt with it, and he can give you the angle on it. He's got there's some deep thinking going on there.
We like good folks like that. So I don't know, Eric, you want to land the plane?
Sure. I guess looking back, Tobias, I mean, you've had such an amazing career so far that's spread across. You're going through law, writing the book, the blog,
M&A, the activism,
the ETF. Looking back for someone that's starting out today, I mean, what piece of advice would you give them, or what advice would you give your younger self, knowing kind of the journey that you've been on so far?
Oh, that's a good question.
I would say, if you can do it, try to get into something like Columbia. Get into the Columbia program. If you can do that, do that. For the very vast majority of people, that's not going to be a possibility. So they, or equivalent. I'm not saying necessarily just Columbia, but Columbia is such a great brand name that you are then going to go and walk. Assuming that you want to be an investor, you want to be a value investor, you want to work in a firm or ultimately run your own firm. That's where you want to start. You've got to be investing for yourself in your PA. You've got to be buying positions and holding them, because until you really do that, you don't know the pain and the pleasure of like doing a whole lot of work and seeing something lose for a long period of time, and then having it turn around and work, and sort of dealing with your own emotions through that process. And the other thing that I would say is to write a blog. It's just like writing a journal. Write it anonymously if you have to, or if you want to. You don't want to put your name out there, that's perfectly fine. It's just a great way of putting your thoughts down. So when you revisit a position in 12 months' time, or in 2 years' time, or 5 years' time, you can go back and see, what was I thinking then? How have I evolved since then? What did I get right? What did I get wrong? And the nice thing about the internet, and the reason that I say do it publicly and do it under a pseudonym or anonymously if you have to, is that over a period of time, there are enough people out there who read this stuff. And if they don't really care who you are, if your thought process as evidenced in that blog is a good one, you will get hired. People will want to back you. That's really all you have to do, because it's the nature of this business is people don't really care where you come from. If your ideas are good enough and they can profit from you, they will hire you or back you.
Yeah, it's a meritocracy of ideas, right? Essentially.
Right. It's kind of like it's a little bit it's a cliche to say, but it's true. It's the nature of it. If you're good enough, that you're going to find a place. And I've seen it happen so many times to guys who are just way outside the ordinary, the norm, not in New York, odd kind of characters, but their ideas are just so strong. Their written expression of what they were doing, they worked. They got picked up by big funds. So it definitely happens, and it works.
Yeah.
Tobias, thank you so much for being on. We really appreciate it. Where can people go to find out more about you? Where can they follow you?
So I'm on Twitter, Greenbacked. It's a weird spelling, GREENBACKD. And I have a website, acquirersmultiple.com, which has a free screen for large 1,000 stocks. That's got all the books and all of the other stuff on it. The firm is Acquirers Funds, and the 2 funds that we're managing at the moment are the Long Short Acquirers Fund, which is ZIG, and Long Only Small and Micro Deep Value, which is DEEP, DEEP.
Like it.
Nice.
Thank you, Tobias. Again, really appreciate it. Pleasure having you on. For all you listening, you could find out all of our other blogs anywhere podcasts are available. You can check us out at snn.network. You can check us out on the SNN YouTube channel. That's youtube.com/SNNWire. Remember, I'm Eric. This is Gary. Thank you for joining us. We really appreciate it, and we'll talk to you again soon.
Thank you.
Thank you, Toby.
Thank you, Toby.
Thanks, gents. That was fun.
The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.